Domanig. I'm the managing partner of Emerald Technology Ventures, and glad to be invited here. And we're going to be having a panel discussion today about financing energy innovation. And I've got some great panelists here I'd like to quickly introduce, and then afterwards I'm going to hand them over to tell us a little bit more about what their companies do. So my first panelist is Jamie Arbib. He's the founder of RethinkX. It's a not-for-profit think tank that has developed a framework to better understand the non-linear nature of technology disruption across the economy and its broad implications on society. We also have Max Bock. He's a managing investment manager at Gründerfonds. He's been supporting over 60 startups, and he focuses on nano and quantum technology, materials and environmental research, as well as Industry 4.0 and the future of work. And our third panelist is Geert van de Wouw. He leads Shell Ventures, and they are focused on renewable power and heat, climate tech, digital, and mobility. Shell is obviously one of the most active investors in this space, and they currently have over 90 active portfolio companies. So with that short introduction, I'd like each of you to tell us just a little bit more about what your companies do. And if you wouldn't mind, Jamie, can you start?
I certainly can. Thank you very much indeed. So I'm Jamie Arbib. I'm co-founder of RethinkX. We're an independent, not-for-profit research group. And we look at technology disruptions. And we've built a complex systems framework through which to understand and analyze technology disruptions. And we tend to get a very different outcome from our research and analysis from a lot of the mainstream forecasters that you'll see. And so we recently published a report on the electric power sector. And we see some extraordinary outcomes as we transition over the course of the 2020s. So first of all, what we see is just the extraordinary cost improvement. So solar, wind, and batteries, dropping very quickly. And we're at the point now where solar and wind are the lowest cost forms of generation in large parts of the world. And we're not far away from the point where solar and wind become cheaper than just the marginal cost of conventional energy generation. And this is profound because we've seen a disruption to the new build power market. We're about to see a displacement of existing energy assets. And we're also seeing batteries begin to compete in the peaking market. They can offer lower cost peaking resource, which is disrupting that part of the market. But as the cost improvements continue, by the 2030s, we expect a 100% renewable solar, wind, and battery system to be the lowest cost form of energy generation that we can have. And what's interesting is that when you build out that model, you get a completely different architecture to your energy system. So you build, or we think you'll build that system through the late 2020s by building a massive oversupply of solar and wind to minimize to minimize battery costs so that you can meet demand on the darkest day of the darkest year. And what's interesting about that system is, you build this low cost system and you get a superabundance of energy on pretty much every other day of the year as an outcome of that. So you'll have what we call superpower, which is this essentially zero cost energy. And we think that'll transform the economy. It'll transform far more than energy generation. Almost any demand that becomes shiftable will shift to take advantage of that low cost. So it will have impacts on, for instance, steel production, cement production. We'll be able to produce hydrogen, for instance, based on that low cost energy production. We'll be able to desalinate water, electrify transport, maybe electrify the heating in buildings and all kinds of other things. So in our analysis, we see this as a disruption that's driven by the economics. We don't need new technology. We've got everything we need. So the challenge is really in terms of financing the scale up, and also the challenges in how the rest of the economy adapts to what is a fundamentally different disruption. We think that most of the mainstream analysis tends to look at disruption as a sort of one-for-one substitution, that we're going to build a solar plant to replace a gas plant or a coal plant. It's not like that. Disruption doesn't work like that. It's a phase change. It's a change in system state. I think I'll leave it there.
Great, thanks. Yeah, we're going to come back to that point in just a minute here. Max, can you tell us a little bit more about Gründerfonds? Because that would be interesting, I think, for our audience to understand kind of why it started and how it's structured.
Absolutely. I mean, Jamie gave a wonderful introduction already in the field and the future outlook, and I couldn't align more on that. High-Tech Gründerfonds started off as a public, and today still is, a public-private fund, meaning that the German government took upon itself to help fuel this innovation in many different aspects, upon one of which the electricity and the essentially also the Energiewende, as we know it in Germany. We are on the private side backed by 35 of the largest German companies in this space, including energy companies like RWE, EWE, Stadtwerke, Tüger, and a number of others, which show also the huge interest in the market to not only back innovative startups at this very early phase in order to build out also the European model of innovation in this space, but also to for large companies to observe and learn also from these younger companies, and then have a natural integration point later on. So a lot of our investors in our fund basically use this as an opportunity to enter at later phases of the business, which gives us a tremendous leverage for the startup teams joining early to have a long-term future. Happy to share more also about my portfolio in the question time, but I leave it now to the next panelists to introduce themselves.
Great, thanks, Geert.
Thanks, Gina. My name is Geert van der Wouw. I'm heading up Shell Ventures. We are a global corporate venture capital player in the renewable energy and future mobility space, with presence in 7 locations in the world, from which we source investment opportunities for Shell, really with the view to get access to new technologies, new ideas, new business models that can help us build the renewable energy and the mobility business that we are building. Shell is, of course, already a major player in mobility, but we're trying to transform into more of a service-oriented provider from a product-oriented provider. And we've made strong commitments as a company towards decarbonizing not only ourselves, but also our customers through a sectorial approach. And startups for us play an important role to actually bring new technologies and business models into the company and help us, develop new business models inside Shell, help us grow new propositions to our end customers. And so we actually do put, and I think it's a major responsibility that we have as a corporate investor, a lot of effort on helping our portfolio companies grow and find revenue generating opportunities inside Shell, but also outside Shell. And for that, we have a group in my team that is focused on implementation management. So they will basically broker connections between the companies we invested in, or the companies we are going to invest in, and the various Shell asset managers and projects and business managers, making sure that we help grow and develop companies.
Super. Thanks a lot. That's helpful. Max, maybe I could start with you. I mean, one of the topics of our panel is also to talk about this public-private acceleration of technology innovation in our sector, in the energy sector. Could you talk a little bit about, there's so many different government models, right, across the world. Governments are obviously very interested in supporting innovation and entrepreneurship. And High-Tech Gründerfonds has been particularly successful in accelerating the technology innovation in the energy sector. Can you explain to our audience just kind of a couple of ideas of why is that so? Why have you guys actually been able to crack the nut when some others have stumbled?
Thank you. Very good question. We started essentially also our fund with the principle of saying this is not a grant or another grant scheme for startups, but something that has a market validation to it. Our companies that we accelerate, or actually, I shouldn't say accelerate, but truly invest in, have an evaluation. They've been scrutinized. The due diligence process has gone through. The technology has been taken apart. HEGF is a seed investor and one of the largest in Europe. And we pride ourselves at, including myself, we have a technical background, so we can really deep dive on these technological terms prior to any financial revenues being in the field and being able to jointly flesh out a future. And what we do is we give that confidence to private investors later on down the line to see the potential of these startups that basically would be eligible for grants, but then struggle to find that initial financing. And it's this gap in the market that HCGF has been addressing over the last 15 years and is continuing to do so, because we see that even with more investors entering the seed phase, there are a number of sectors, especially when they become more risky, more renewable orientated, that it becomes very interesting, the question to how to help those teams at these early phases and really gain that traction in the market. So our model is very much aligned with the private industry, despite being a public-private fund and not so much a grant-giving scheme. Nonetheless, thanks to the government support, we have that volume. Our fund with 40 investment managers actually has a capacity to look at a huge range of startups emerging from Germany, but also surrounding areas across Europe, and take the time to deep dive into the technology and really drive innovation in this energy sector. That could come from all the things. We have a number of startups in our portfolio, for instance, that look at optimizing wind energy. What if climate situations change? How's icing treated, for instance? Another one that is fueling the hybridization of grid-level energy by bringing together battery storage and solar panels and making them today already an economic model. It's these things that I think played a huge role in the market, and we're so excited to be one of the players here to enable and fuel this innovation.
And so just maybe a follow-up question on that. So does the government actually get involved in defining the sectors that you're to focus on?
Actually, in that space, we have almost the opposite of a definition. We have the definition not to exclude certain sectors and be very broadly based. Naturally, however, you probably know this from the VC market, there's certain fields that are today on vogue, or at least at the beginning of their phase, and other things that have already passed. There are a few examples like Bitcoins and other things where the actual bonanza time for investments has already passed that phase. I would say in the solar panel space, for instance, a number of battles have already been fought and carried out. So now it's the question, what is next? What are the new battles outlined? And that's really exciting to see what kind of innovations are fueling and driving not only the German economy, but also Europe as such in that space.
Super. No, thanks for that. Jamie, you talked about this massive energy transition, and Max and Geert and I are, of course, in the business of going out and backing hopefully the winners. But there aren't only winners in this transition. There's obviously the incumbents who might be saddled with legacy assets and whatnot. Can you discuss, what are some of these challenges that the incumbents have, and what do you think the role of government is in that part of the transition, not in just the supporting the seed financing of startups, but of also helping the incumbents transition?
Yeah, I mean, that's a really important question. So, I mean, we study technology disruptions, and there's a very poor track record of incumbent businesses being able to adapt to disruptions once they get underway. I mean, you tend to get, obviously the virtuous cycle that drives the adoption of new technology. You get, increasing economies of scale, decreasing costs, more investment, more government support, kind of reinforcing each other and driving a technology disruption along that S-curve. But there's a kind of inverse of that, a mirror image of that happens for the incumbents, which is a death spiral. You have reversing economies of scale, increasing costs, less investment, less support, and so on and so forth, that leads them to break down very quickly. And the collapse of incumbent industries can actually happen really quickly. There's obviously both operating leverage and financial leverage that can play a role in that. And so when we look at the power market, what we see happening to conventional power assets is a drop in capacity factor, in the utilization rate. And we think that's a very significant factor that's completely omitted by mainstream analysis. In fact, almost all of the analysis you'll see from governments or the big NGOs that cover this kind of stuff assumes that capacity factor is a constant. They model in terms of levelized cost of energy, they model an 85% capacity factor for most conventional assets. ad infinitum into the future. But what we're seeing is as solar and wind are playing an increasing role in the market, we're seeing that drop. And we're seeing it drop substantially. And you'll see the IEA forecasts that just, every year, they for instance, for coal energy, they'll lift the forecast up and see a bounce back. It's not coming, it's going. And the capacity factor is going to continue to drop. And what that means is actually for any new conventional power plant built today, the cost is far more than we think. So the cost of coal, because what you're doing when you're calculating the levelized cost is you're taking all the costs involved over the lifetime of the plant and dividing it by how much energy it produces. And if that amount of energy is far less than is anticipated, then the cost is far more. And so there's absolutely no reason to build a new conventional power plant anywhere in the world today already. We're just making a mistake that stops us from realizing that. So we think that there's this inevitable disruption driven by the economics underway, and actually one of the challenges is how we navigate that, because what we'll see as capacity factors drop, conventional power will become like peaking power. It'll only be used part of the time, but they won't be able to charge peaking prices because batteries will come in and cap that. They'll provide a ceiling to how much you can. So we see essentially a widespread destruction of value. And actually, if we want to keep these plants operating, to keep the lights on as we go through this transition, we're going to need to think about subsidizing conventional power plants to enable the transition to happen. So that's one role for government, is to understand how quickly this might happen and the sort of interventions they'll need to keep our grid system stable. But more than that, there are social aspects. Right, as industries get destroyed, we tend not to see these disruptions. We stumble into them and clean up the mess retrospectively. Communities and jobs destroyed, and the social aspects are incredibly important. And our view of this is we should adopt a principle of essentially protecting people and not businesses or assets. We don't want to be propping up businesses that make no economic sense, but we certainly need to be protecting the people and protecting those assets that we need into the future, but certainly not all of them. So yeah, there's a lot of work to do, but it kind of starts with opening our eyes to what's really happening and understanding how quickly and how powerfully this can happen and how profound the consequences of this change are.
I agree. I mean, it's super interesting. I think that obviously the role of government to ensure employment, retraining of people is paramount in, so you don't have kind of a backlash from society because of unemployment in certain sectors, which we see in certain geographies of the world. But maybe to go on to Geert, so we talked about this pressure that's being put on the incumbents. A bit about how government can play a role, but you are one of the large incumbents, right? So what do you think the incumbent's role is in kind of developing these technologies and making sure these technologies get deployed, even when it may be kind of seen as a threat to their to the legacy business?
Yes, well, first of all, let's take away a myth that somehow this is a threat to our legacy business. I mean, Royal Dutch Shell as a whole is only 3% of the energy mix, right? So we cannot, let's not have the pretension we can influence the speed of innovation in the energy space. So we need to embrace it. And so our ability actually to source and scale innovations faster and more efficient than our competitors and forge strategic relationships and partnerships with third-party innovators to achieve that becomes actually a significant competitive advantage to Shell in the energy transition. So if you want to lead in the energy transition, then just focusing on corporate R&D to rely on innovation is not going to be enough, and we realize that. But there's a couple of challenges and opportunities that come with it. I mean, the good news is there's a lot of money currently being put in startups and scale-ups in the energy domain. We estimate roughly between 30 and 45 billion a year of relevant to Shell investments are happening in the VC domain. And what we see also is that sectors are coming together. The tech sector is collaborating with the energy sector to basically decarbonize the supply of electricity to their data center. The tech sector supplies web services to a company like Shell. We both large suppliers and customers of each other. And we also both looking at nature-based solutions and agriculture as a way to, on the short and medium term, help decarbonize the value chain. And so you actually see agriculture, energy, and tech coming together around the same theme. So I think there's an opportunity really for collaboration between large corporates and sectors to try and achieve the same objective. Now, the challenges I see is one is supply chain makeup. I see that, the energy industry still uses an incumbent supply chain that doesn't innovate necessarily always at the speed that we need to meet the challenges of tomorrow, right? I mean, this supply chain is deeply embedded in whether it's in offshore oil and gas or offshore wind, and they don't necessarily make the margins to afford R&D or are not necessarily incentivized to actually innovate and bring new technologies and business models to the field. So that's really a challenge of inertia that we will be facing as a company. I think the second challenge for us is the availability of funding for repeat projects, right? And especially the first of a kind project is hard to fund. But how can we then, once we've built, let's say, one bio LNG facility in the Netherlands, how can we replicate that technology, 20, 50 times across Europe to liquefy biogas from renewable sources to a transportation fuel, and so how can we collectively, not only as a corporate but also with the financing sector, make funding available for repeat projects? And I guess that the third challenge is internal culture, of course. Big corporates, people sometimes have the tendency of not innovating here and not innovated here, not invented here. So that's something you need to overcome by actively I think brokering and connecting the dots between the startups and the portfolio companies we invested in and the asset managers and the people working in the business, but also help the startups and the portfolio companies understand that their solution typically is a small part of a much bigger integrated solution, and so they need to really apply some systems thinking into their organization and look at how does our solution fit into the bigger picture, and how do we make the implementation more flawless. So these are some of the challenges that we're facing. Now, I think as Shell, we have a responsibility towards our portfolio companies to really, help them overcome those kind of challenges, whether it's finding funding for repeat projects or helping them think about systems integration when they try to implement something within Shell, et cetera, et cetera. But there's really, broker the connection and the efficiency and the interface between the portfolio companies and Shell where we can add value.
Thanks. Yeah, I think that the point that you brought up about collaboration, I think, is really important, right? There are these different players. You mentioned also the finance industry, but Max talked about, kind of one model of government's role in kind of accelerating the seed financing part. But I'd like to open it up to you guys to give some ideas or share with us some models that you've seen of this where this collaboration is actually working and where you think it's not working, where you think kind of either the private sector or the public sector needs to come to the table.
Yeah, if I may, Gina, and sorry, I've been talking a bit, so I'll keep it short. But I think there's two main challenges there, two missing links. And High-Tech Gründerfonds is really good at it. But, I see a lot of VCs pulling away from early stage investing. And I disagree with one of my panel members that we have all the technologies we need for the energy transition. I think there's still a lot of early stage stuff that we actually do need to nurture and grow to scale in order to actually, become to thrive for carbon neutrality. That's one missing link, I think, is early stage investing. And secondly, I think, what I often see, I call it the valley of death for these startups is startup has developed the technology, has done a few small scale pilots, and now it's time to build a large scale facility. And suddenly we need $50 to $100 million to invest in a commercial scale plant. And the VCs have tapped out because they need to raise a new fund and they need to force an exit. It's still too early, too much tech risk for the PEs and for the institutional investors, and the only folk around are the corporates. And that actually is a real hurdle that we collectively, I think, as a sector need to try and overcome. Because once we now have a couple of these technologies that are really promising, but how do we actually scale them to size? And scaling is really important in the energy sector. You know, 1 or 2 plants is not enough. You know, the replication piece is really important, and I think that's where, you know, we need to come together with a variety of players, including governments, to make those first of a kind plants happen.
Exactly. Jamie or Max?
Jamie, if you want, you can go first. Otherwise, happy to jump in here. Okay, I'll go first. Absolutely right, and I think Geert's point, both of his points are true. That it's surprising how much innovations freedom is actually still out there and needs to be still shaped, taken and formed in a way by future teams, by innovative groups and projects, in order for us to be truly getting closer to our goals that are very ambitious for the next 20 to 30 years. And I would say even so ambitious that if we just follow roadmaps that are existing today, we would never reach them.
Yeah.
So we need breakthrough technologies even today still in lots of different aspects. That's why having this heterogeneous approach of not relying on 1 or 2 sector players, but really everyone in society to engage on this field is really important. The second point is, and I also agree with Geert on that one, that phase between, or I wouldn't call it the valley of death, because the valley of death is usually where we meet the teams for the first time.
Yeah.
They just got their first, essentially, grant or something, and then no investment.
We need a new word, Max.
Yeah, we need brownfields, maybe it's appropriate.
Yeah, exactly.
It's absolutely right, and it was actually addressed internally with us as well, and we've been looking into a setup which we call the Deep Tech Futures Fund, which takes these businesses at this scale-up phase, where 50 million is an order of magnitude that is actually necessary in order to go the next level and really build out the future teams. And it's partners like Shell and others who enable this future. And again, I believe it's this mixed breed between public and private that can really drive forward this future. And I'm starting to see an understanding, not only from the German government side, but also other governments around us, for this appreciation that there's also a capital need in that space. Yeah. Prior to that, it was just, seed stage. How do we get to that first valley of death? Now it's this understanding what happens next. Why do they still get stuck? And it's also, outside the energy sector, really important for the future of Europe to be competitive. If we look at the US or Asia, far behind in terms of innovation in other spaces.
Max, we only have 2 minutes left, so I want to hand over to Jamie and get some insight from him. He's the one who's supposed to bring this all together, the systems thinker.
Well, this is not my area of expertise, but I do think there's a mindset challenge here. I think that's kind of central here, because the engineer's mindset, the old industrial mindset says, look, we've got a problem, and we need to find a replacement for all these things to make things better. But actually, the world is changing so fundamentally that everything's kind of bleeding into each other. So, transport and energy and electric power are merging, as is agriculture and food and materials and healthcare, actually. And so the solution to, problems, we often think about, we've written about the disruption of the transportation sector and about the technologies that might disrupt it. But I actually think the bigger disruption to transportation comes from outside of transportation. It comes from a disruption to the need for transport. That we're seeing that all the things we travel for, we might not need to do. But more than that, actually, we'll have a new production model where we don't just have huge flows of physical goods through the system. We have a much more distributed kind of manufacturing system. We don't transport huge quantities of raw material to power our system, and we don't and we make and manufacture everything locally based on stuff that's available locally. So it's getting our heads around that kind of that systems approach and understanding the kind of cascading consequences of change elsewhere, and we need an ecosystem approach. If we want to get these businesses funded, we need academia, we need policy, we need consumers, we need business, we need all parts to kind of come together in a much more integrated fashion. Finance can't sit on its own as one piece of that